I do not think the U.S. is currently in a recession.
Woo, baby! We went through the pandemic and stepped into the twilight zone, and we've never been able to get quite back out of it. We're going to be listening to Jerome Powell explain why we're not in a recession, and then we're going to take a look at the data that he's pulling from and take the broad view perspective from the recent earnings we've had to see exactly where we sit, not only within the stock market, but just the general economy. Now, that is a conversation you can appreciate. Hit that like button because let's listen to good old Papa Powell.
I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month.
This is where the disconnect happens with the media, because all we're hearing is Shopify's laying off 10% of their staff, 1,000 people, all these companies going on hiring freezes. But then you go to the commodities market, the oil market, the construction industry. A lot of people in construction struggling to find reliable workers. So it's hard to get the broad view perspective, but we'll take a look at the data points in a second.
That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
The Federal Reserve truly only has one job, and that is to keep unemployment low. And that is what everybody is basing their opinions off, even though we're in a technical recession. And we'll look at some of that data from the GDP perspective, but take a look from past historical recessions and pretty much terribly depressing periods, and look at what happened to the jobs market, because in the 2008 level, guys, the unemployment rate just absolutely skyrocketed. In the pandemic, absolutely skyrocketed. Heck, even during the dot-com bubble, some of these inflationary rates from the 1980s, yet still, even with all the hiring freezing and some of these layoffs, we're still seeing absolutely historical low unemployment. So that's the first thing that I find very intriguing. The second thing is consumer spending. Now that we've had some earnings come out, guys, just taking a look at MasterCard and Visa, these growth rates these companies are experiencing are insane. I mean, take a look at this, 21% on year-over-year growth from 4.5 billion to 5.5 billion in net revenue for MasterCard. Insane. Take a look at Visa's net revenue is up 19% year over year in the midst of what is supposed to be a recessionary period and what a lot of people are calling the next Great Depression. We're going to see everything go into complete calamity, and it's hard. Who do you trust? Papa Powell, the man told us that inflation was transitory, and he's been wrong. They've been slow on interest rates, but how do you trust? I mean, you're going to listen to the bears out there, the gold bugs, the negative Nancys. I mean, your Michael Burrys and your Peter Schiffs of the world. It's really hard to find that middle ground of what is the real information out there, right? So taking a look at the historical annual savings rate, this is very convoluted, and I like the beware the health or the wealth effect. During economic expansions, when the value of stocks and homes increase, Americans tend to save less than during a recession. Governments help through the pandemic, including stimulus checks and advanced child tax credit payments, boosted savings rates to levels not seen since the 1970s. So this is something that we saw in the pandemic there. A lot of people had a higher savings rate because of the government pumping that money out, and on average Americans are saving well below the 10 to 15% consistent annual savings rate required to successfully fund retirement. So this is another thing that's been shrouded over the market. We can't really trust the savings rate data because a lot of it was boosted from the stimulus, but even now in this recessionary period, the likes of JP Morgan, Bank of America, even a lot of the Canadian banks are saying that the consumer is very strong, and that is some of the data, again, when we look at the consumer spending that the Federal Reserve is pulling from. And the only people getting absolutely devastated and wiped out right now, we're hearing these horror stories, are leveraged a-holes. I mean, we're talking about the crypto leveraged monkeys, the kids in their parents' basement that were 20x leveraged into Bitcoin and Ethereum and all their altcoins and their NFTs to only go broke. And we're seeing the same thing in the stock market. This is what is unwinding right now. Take a look at the FINRA statistics for margin. People taking out debt in their trading accounts. Well, as of June 2022 here, guys, there's $683 billion from a high that we reached at the beginning of the year of about $829 billion. So this is drastically month over over month, unwinding all of that leverage in the market, which arguably we could say is a good thing, and it's helping us find a new bottom because the market is rallying, right? So taking a look, we just came out of one of the most intense earnings seasons, one of the most historical moments in my entire investing career, because everything posted this mixed earnings. I mean, it was a double-edged sword for everybody. Like Coca-Cola was probably one of the few companies that absolutely slaughtered, but from GM, McDonald's, a lot of these companies, even though McDonald's posted good numbers, they have to increase prices to keep the revenue growth rates. GM just got wrecked because of logistics problems in China. We've talked about this. But Google, Microsoft, all these companies were posting very good numbers, but we're seeing that slowdown they're mentioning in those growth rates, right? And it was just crazy, right? Like Meta got hit, absolutely devastated, but we saw the likes of Pfizer getting into some of the healthcare sectors, posting really fabulous numbers. A lot of the travel companies doing fairly well. The oil companies that posted today, absolutely crushing it. So it's a very broad mixed, right? I mean, you can't take one of these earnings as the true defining factor into what's going on. And the only company that I really use as an indicator to if we are in a true recession or not has got to be Apple, because Apple's become a staple based product. Everybody needs a phone. Everybody wants their basic, got to call somebody. So the fact that their total net revenue grew pretty dramatically, and when I mean dramatically, I mean for this time period of slowing growth, because basically from last year, they went from 81 billion to 82 billion, or almost 83. So they're still able to grow, which means people are still spending money on these phones. And we can see that when we take a look at the net sales by category, because phone segments are still growing here from 39 billion to 40 billion, yet the Mac sales are down. The iPad sales are down. The Mac, so basically the MacBook, the iPads, basically everything outside of services and iPhones saw a decline, because I don't think those are necessity-based products like iWatches, iPads, MacBooks, very expensive. So it's no surprise people have been pulling back on the premium-based products and focusing on more or less the staple-based products. But this is very good. This is setting up, for me, in my opinion, a brand new bull market, because this data, if this is like the leveling off, once we get through this recessionary period, people become more confident, and spending comes back, the economy comes back, real estate cools off and starts rebounding. The stock market is already beginning to rebound. I mean, take a look at this, the S&P 500 now, and this could be a bear market rally. I don't know. I'm not a fortune teller here, folks. I just cost average, and I think tech is starting to see its bottom. So I am buying things like Google, but it is up 12%, guys. Year to date, we are now down only 14%. So we are out of bear market territory technically, right? So the NASDAQ here down 22.23%, and the S&P TSX on the Canadian side of the border only down 7.48%. All of this leads into this GDP data, just taking a look at the very, very broad view perspective here, guys. And we can see that GDP is, again, we saw about a 1.6 or something percent down in the first quarter. In the second quarter, we're under 1%. So this negative GDP, again, is really hard to tell if it's a self-fulfilled prophecy. As I've mentioned, fear compounds fear. Okay, so what ends up happening is when everyone's telling everyone the world's falling, people freak out. I know people canceling their Teslas. I know a lot of people just saving money. They're just being very frugal and prudent in this current environment, right? Even though that prudency might be a little bit overextended. So somewhere in the middle there, when people's confidence starts coming back, I think it's just going to push us into a somewhat of a rebound as the market tries to find that equilibrium and that nominalization to what truly is the emotional sediment and what is the actual reality of job losses and issues impacted by the recession, right? So like I said, I am overall, if I'm talking like 1-3 years out from now, very, very bullish on this market outside of perhaps a black swan event. But I think this quarter is the most impactful. Next one will be the follow-up, where I still think we'll see nominal growth, and then somewhere toward Christmas we could start seeing that holiday rally. But I want to pass the question off to you. I'd love to know what you think about all of this in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.